Hey, thanks for tuning in. We have a Boulder County market update for you. It's Tucker and Anthony with Land Title. Anthony, you want to dive in?
Yeah, let's dive right into our lender update for the month. Just wanted to point out some of the things that you probably are feeling, but we want to validate what's going on out there. Inventory really has been tapering off since about July, right? We've had so many frustrated sellers, expiring listings, and all that, really bringing that down similar to last year. We're only up 8% active units. The very cool part about this, though, is also buyers have slowly come out to market and continue to participate. We have 7% more under contracts in the last month than we did prior to. So that year-over-year change is definitely subtle, but it is a step in the right direction.
And remember, we had that great Q4 last year. So the fact that we're even up right now heading into November here, our October stats, this is a really good sign.
Yeah, the last thing on here is average sales price is showing up 1.9%. But what I do want to point out is how drastically different that probably is going to be based on price range and location across the county. Certain places have suffered a little bit, and other places have done better than expected, especially at the median. All right, so let's talk specifically more about inventory, Tucker.
Yeah, so really good point. Anthony, move your head over just a little bit.
Oh,
Other way. Perfect. So let's look at our sub-counties, right? And our sub-markets here. So what we're looking at, overall, we're at 1,400 units on the market in Boulder County. We are down month over month, so we had a nice decrease of about 5.5%, but we're still up year over year in our actives, right? Now, when we're looking at our sub-markets, where we're really seeing where's the inventory stacking up? It's Boulder and Longmont, right? Those are the two main spots. But when we're looking at it, we've had a little bit more decrease in Boulder and Longmont and active inventory. But what's surprising is we've actually had a little bit of an increase out in Lafayette. So seeing that increase out in Lafayette and Erie kind of shows where are the active listings right now and what's getting more competitive and less. So you can see Erie and Lafayette are going to have a little bit more active inventory, so they're going to continue to be a little less, easing up on the buyers for you. Whereas here in Boulder and Louisville, Superior, we're contracting in our active listings, especially here in Boulder. That's where we've seen the biggest decrease month over month.
Okay, so what does that really mean, right? Month supply of inventory tells us what does it feel like to be a buyer and seller. NAR would say that 4 months of inventory puts buyer and seller on even footing, which we know locally is really not the case. I mean, we've seen so many concessions and all this other stuff. It probably feels more like 3 months, anecdotally. But the real issue is when you look at it by where it's happening across the county. The city of Boulder, because of its price in many ways, is at 5 months of inventory. It is truly a buyer's market in many ways, right? But there's a lot to be said about all the L towns out in the county in Erie where we're really lower inventory levels, way more manageable. And, a few months ago, it may not have seemed that way. So the fact that we've seen so much come down off that active units, yes, month supply across Boulder County is 4 months, but I mean, look at Louisville. It's only 2.7. Lafayette, even with the rise in inventory, still at 3 months of inventory. So it really is a competitive situation out there for some of the better properties, and those ones that have been sitting on the market longer, obviously, you could definitely go out and probably find some deals as well.
So looking at the days on MLS, we'll go a little quicker on this, right? This has to go under contract to be registered in here. So if it was taken off and put back on, this is where we're sitting at. It's still showing really high days on market, but certain areas are a little bit faster, right? Superior and Louisville are going to be much quicker. So if your buyers are interested, they want to get that second tour before they put an offer in, they may need to act faster in those submarkets, especially that Louisville and Superior area, where places like Boulder, even Longmont, Erie, you're going to have a little bit more time to get that second look, have a little bit more of that due diligence up front that we've been noticing a lot of buyers are doing right now.
Okay, talk about actives and solds by price range. There's some big major overlying trends. I think one of the highest trends is that the luxury market is moving better than usual, right? Yes, the 3+ million market is similar to last year, even down a little bit as far as year-to-date sales. But as so many of those people got realistic on price, we really started to see people buy the 2.5 to 3 million market. And so the luxury market, anything over 2 million really, has done remarkably better this year than it did a year ago. Now, the issue is what cost of money is, as it's been expensive to purchase, that 1.5 to 2 million market is really where we've seen some contraction in the marketplace, where the rest of the market, the average, the median, anything under that 1.5 million market, we really have seen that slight, slow and steady increase of buyer activity, which is very exciting to see in this last month.
We've really needed
it.
But
you really are feeling it there at the median, right? Those people that have been waiting, and maybe they're just tired of waiting. They're starting to come off the sidelines as far as those sold numbers. The active units of inventory, though, also following similar trends. You really are just seeing a lot come off the market across almost every price range.
Yep. Now, when we're looking at this is for detached single family houses. We're looking at that month supply of inventory. And that was what we were looking at overall for the whole county. Now we're looking at by price range and just for detached houses. And you can really see how cost is a complete function of that ratio of demand versus supply. And as we really go all the way up to that $1 million mark, it's pretty similar in the competitiveness of sitting around, 2.25, 2.5, 2.75 month supply of inventory. And that's really just showing, yes, it is leaning towards the buyer, but it's not as aggressive as it is when you talk to your buyers and your borrowers over that $1 million mark. And you can really see how each price band, every $500,000 to go up, you can really start asking for more and more because of the inventory versus the demand out there. It's just really showing this function of a cost.
I think the days on market really shows us that the better homes, the stuff that's buttoned up, ready to go, priced correctly, is selling across all price ranges very quickly still, within that 30, 45-day timeline. But it does tell us that there's a lot on the market that just isn't selling at all. And so that's kind of changed those numbers. If you look at it in the attached market versus the detached market, this is where we see a very different flip side of the coin. The lower end stuff in the attached market is having a lot harder time moving. There's so much more inventory out there and active out there. Then you've got all this stuff in the average days on market where it is just taking longer to sell because there's just not as many buyers looking at this market. Now, the luxury market is almost the flip side. It feels a lot like detached. The really cool high-end stuff where people have capital for it. They're coming in, be able to stroke a check. I mean, look at what happened from 1.5 to 2 million last month, 11 days on market, and some of those are just moving quickly. So it is really a function of product type at that high end, right? Luxury, really neat stuff and great locations is turning just like the detached. The rest of the market is still suffering, as we've seen.
All right, so looking at our average sold price for detached, what we're really kind of looking at here is let's see what counties are up and down. And remember, it's a lot of it's that composition of sales of what's being sold and what's not. But we can see there is slightly, across that board, we're really seeing a decrease, except for a couple of areas in that TTM change. And that's really just a comparison of the last 12 months compared to the previous 12 months. So we can see a trend of prices. And what you can see is all of our submarkets are down except for Superior and Louisville. Why is that? Remember, those are the new builds from the Marshall Fire. So what we're seeing in these stats, because it's a different, it's not the exact same house that was rebuilt. We know that. It's a much nicer, newer, brand new home. It's going to be sold for a lot more. That's why we're seeing average sold prices increase in Louisville and Superior, not because the market is that much more aggressive. Yes, they're doing better than Boulder, but it is, keep that in mind. It's the average sales price isn't for the standard house. That's because of those new builds really making a big impact on that pricing.
Right. Detached single family, I think the key in Boulder County, right? There's some ugly numbers there, but if you look at it across the board, the key is stability, right? In the last 12 months, the change is 0.01%. So it is as flat as they come across Boulder County. Yes, certain, luxury might not be doing as well as certain areas and yada, yada. But in all reality, it's very stable in Boulder County. And I think that's one of the biggest takeaways you can take in the detached market. When you compare it to the attached market, it's where we really start to see, maybe some of the cracks in the housing market. And this is where we usually see this in any down market. The attached market suffers first, it suffers worse, and then it comes back faster, right? So the interesting part is, it bounces around so much. When you look at the graph, you're like, what are we even looking at? So when you look at those trailing 12-month numbers, it shows us more of that consistency. Now, the big difference with our average sales price in Boulder this last month, because a lot of people have been pointing this out to me, it was nearly 100,000 more than the average. So we just sold more luxury in the city of Boulder. That doesn't mean that housing prices skyrocketed 6% last month. It means our composition of sales is different, and it really has changed that TTM percentage change. Mm-hmm. I would say that the lower end, stuff that was built 70s, 80s, 90s, they may still be decreasing very similar to what you're seeing across most of the county. But because of that luxury product, because we're seeing more of it sell, it on paper looks like the city of Boulder's prices are rising when it's a composition of sales change in so many ways. So when you look at, Erie is the only one out there showing a positive number, but keep in mind, there's no older product. It's all newer townhouses. So they're very similar to single family homes in many ways.
And remind your borrowers, hey, if they're really shopping for the best bargain, attached right now is, especially on the lower end of attached, when you're looking at
there's a lot of cool parts.
Those $400,000 condo townhouses in Boulder County, there's a lot of inventory out there, and you can be really aggressive because those things have been sitting. And that's why the days in market aren't really showing up. because they're not even selling. So
yeah,
that's
and a lot
really,
of them have gotten rented. So I think there's probably a lot of opportunity there. It's definitely coming back on the market next year in some ways, or in the next 2 years. Definitely keep your eyes on the attached market. There could be a plethora of opportunity there.
Yeah, for your buyers. Okay, so we're just looking at overall units sold for this year compared to last year. Grays last year, reds this year. What you can really see is we've had a really nice year so far since June. We've been beating what we did last year. Of course, last year was tough, so I'm not saying it's a great year, but really look at Q4. And this is, I think, the biggest piece, the biggest takeaway right now is keep engaged with your buyers through Q4. Look how much we're even beating last year, and last year was unseasonably strong as a end of the year because of rates, because of prices coming down. People feel like they might being able to get a little bit more affordability or better purchase or better deals, especially in November and December. So really stay engaged with your borrowers out there that are potentially still shopping, especially as rates continue to change. There should be some good legs to this market through the end of the year.
Absolutely. If you prime that pump, you'll have a great year next year. And there's just so much opportunity in the last month. I'm always shocked at how many under contracts we're still seeing just because weather's nice and people are continuing to participate. So very different environment than we've been in the years past. I see the light at the end of the tunnel right now. Now, I don't know how long it's going to take for us to get there, but you at least are starting to see things change. So on a fundamental level, that's wonderful news. Now, last slide, Tucker.
Okay, so what we're really looking at, and this looks fairly, we can see it decreases with as the value of the house goes down, the sold to list price goes down. This doesn't capture concessions, though, and we're seeing a lot of concessions out there. So if you want some data on that, reach out to us and we'll share it. But what we're noticing is really once we get under that $1 million mark, it's 98% and above for the most part. And what that really tells us is, folks, you need to, the houses need to be priced relatively accurate, right? And really folks are not writing contract. Your buyers aren't writing contract with the house. They're not even going to look at it if it's not priced right. So that would be a piece of advice to your borrowers. Hey, take a look at those houses slightly out of your range and see if you can negotiate them down, because we're seeing that ability. And now when we jump over that $1 million mark, a lot more negotiating power, right? Because there's just a lot more inventory out there.
Yeah, I mean, the concessions are one of those things, too, where you can set up expectations ahead of time. It's very clear that the 98% doesn't represent concessions. It doesn't represent price drops. And I think the trailing 12-month number here tells us the most about those median average home buyers is they can be more aggressive than they could a year ago. Mm-hmm. So if they were talking about when's the best time for me to get the best deal, you could use a slide like this to articulate, you really need to shop now. Yeah. And I truly don't think it's going to get easier next year, right? It's not going to get cheaper for housing. Rates are starting to dip down just a little bit. There will be more buyers in the marketplace, and all that extra inventory, eventually it's going to get sucked up. I think we might have one more year similar to this, but not quite as extreme.
Not quite as extreme, yeah. I think next year will be our equilibrium year where we really kind of hit that balance and then get back to a nice.
I hope you're right.
Nice, 2%, 3% increase, like Boulder County's experienced historically.
We'll see if the Fed can get their act together on interest rates, because if they do, that's where we'll be.
Yeah, let's get that bond market working.
All
okay,
right,
thanks everybody. Happy holidays. Enjoy your Thanksgiving.
See you soon.